So this is just a quick market update, and again I want to draw your attention to John Hussman's most recent weekly market comment for Monday, March 13th. And if you're wondering why I continue to highlight John Hussman's work, it's because he's data-driven and he backs his views with a wealth of historical evidence. And that doesn't mean he's always right. He could be wrong on this one, but I think it's worth availing yourself of views that run contrary to the increasingly bullish consensus. So, from Blue Skies. The late Sir John Templeton once said, "Bull markets are born on pessimism, grow on skepticism, mature on optimism, and die on euphoria." A week ago, bullish sentiment among investment advisors soared to the highest level in 30 years, joined last week by a 16-year high in consumer confidence. When one recognises that the prior peak in bullish sentiment corresponds to the 1987 market extreme, and the prior peak in consumer confidence corresponds to the 2000 bubble, Sir Templeton's words take on both relevance and urgency. Extremes in consumer confidence, coupled with extremes in investor sentiment, valuation and price extension, have regularly marked important market peaks and troughs. In most market cycles across history, those extremes have usually been joined or closely followed by early deterioration at peaks or improvement at troughs in the internal uniformity of market action. When various components of market internals begin to diverge from the obvious trend, it indicates that investor risk preferences are shifting from risk-seeking to risk-averse, or vice versa. The most negative market outcomes generally emerge when overextended valuations are joined by early deterioration in market action. The most favourable market outcomes generally emerge when material retreats in valuations are joined by early improvement in market action. Now, if you're a little lost in all that jargon, all it really means is that when there's an abundance of optimism coupled with an overextended, overvalued stock market, you should be most cautious. And when there's an abundance of pessimism coupled with a deeply oversold and historically cheap stock market, you should be most aggressive. But unfortunately, human nature works in exactly the opposite way. We tend to get complacent and greedy when the outlook is most optimistic, and risk-averse and fearful when the outlook is full of pessimism. But here's the data I really want to highlight in Hussman's article. This scatter plot shows market cap to gross value added on the horizontal axis. Remember, market cap to GVA is a close approximation to the method favoured by Warren Buffett of market cap to GDP. The reason Hussman uses GVA, not GDP, is because the correlation with subsequent market returns is even better, at over 90%. So this first scatter plot shows market cap to GVA with actual subsequent market returns for the S&P 500 over the following 18-month period, over the last 70 years. So the green line shows where we are today in terms of valuation. And notice anything on that line or to the right, that is equal to or more overvalued than today, shows returns of less than zero over the subsequent 18-month period. Or said another way, at no point in the past 70 years when the stock market had reached the same or even a more overvalued level than it is today, did the stock market return gains over the subsequent 18-month period. Now the next chart is identical, except the returns are over the subsequent 3-year period, and you can observe the same effect on subsequent market returns. Now here's the graph with 5-year subsequent returns. And finally, 10-year subsequent returns. What else is worth noting is that the further you go out in time, the scatter plot of returns gets tighter and more predictable. And this is important because, as I've noted before, this is not a short-term market timing indicator. So if you were to say map 3 or 6 month subsequent returns, they would be much more scattered, with many of those points showing positive returns. So keep in mind, this is not a prediction of an impending stock market implosion in the next week or the next month or even in the next quarter. But you should be aware that the historical record suggests committing new money to the stock market today is likely to have any short-term gains completely wiped out over longer periods of time. And just to finish this video off, Hussman gives us a reminder of how psychology usually plays out at the end of a bull market cycle and the subsequent bear market that inevitably follows.
Hmm. Ah. Hmm? Hmm. Ah.
Don't be that guy. So I know quite a few of you requested some more of this kind of content. Let me know what you think about it in the comments below. And don't forget to like, share, and do all that other good stuff. See you next time.